Alright, so objective. These are the things that I'm going to be talking about today. Objective being the CPI week, right? That's our primary objective of this video. And let's look at how our time frame, higher time frame bias, seasonality, and range helped us define where we are and where prices can go. So if you look at the seasonality, let's start off with the seasonality. Look at the last 25 years of the presidential election years, right? And see how that seasonality has played a role. If I remember correctly, April to May it typically is a bearish overall downtrend, right? And notice that we are in April, May time. We have taken out a important high here with an SMT. Remember, NQ never made that high. So we have a external range liquidity. Where can prices come down to internal range liquidity, which is this is the only internal range liquidity that there is. So seasonality is lining up with our weekly time frame. Higher time frame bias being bearish, right? And then define the range. So if you look at the range, so this becomes our low range, this is our high range. This becomes more clear, right, on a 4-hour chart. So basically, if this is the range low to high, 50% of that mark is right here, right? So this is the 50%. So we are in that dealing range. So if we fail to go above here any higher, and we started breaking market structure, where can we come down into the end of that range, right? So end of the range happens to be this weekly internal range liquidity. So we define the range and then define the intermediate term perspective. So that's the high time frame perspective being bearish. Define the intermediate term perspective. Intermediate term perspective is usually on 4 hours and 1 hour chart. How do we define intermediate term perspective? Well, we have a 4-hour order block here. That was the POI that we've been monitoring, right? So basically all the 4-hour POIs is our intermediate term perspective. What is prices doing? PD arrays, high up close PD arrays, fair value gaps are supporting price to go down, right? They're resisting price to move up. So they're resisting price, right? It's a hot knife through butter technique where it goes through these down close candle with ease, right? These down close candle with ease, these down close candles with ease. These are the down close candle cannot support price. So our higher time frame bias is bearish. Our intermediate term perspective is bearish, and our lower time perspective has to match these two higher time perspective and intermediate term perspective in order for us to take a high probability trade. And going back to this trading aspects of why Thursday was not a good day to trade, because it went against the other two time perspective. So any movement up is a manipulation caused by a down movement. So Thursday into Friday was a market maker buy and sell model. So our shorter time frame perspective did not match with this up movement. That does not mean that you cannot take the trade. ICT took this trade, I think, on his live session he showed. But double check that. So that doesn't mean you cannot take the trade. Is that it becomes a high lower probability because you wouldn't know where to get out effectively, right? So intermediate term perspective only aligned on Friday, and then on obviously on the CPI day as well, which is Wednesday. So it aligned with that, and we can talk about how that came to an alignment. Because price can only do two things, right? When the market opens, price can only do two things. It can either continue or it can reverse. And if it continues, right, how can it continue? It can continue two ways. It can either come up to a PD array on 15-minute or 1-hour chart. So if you look at Wednesday, it can come to a 15-minute or 1-hour chart. There was no PD arrays here, so we did a turtle soup. So we turtle souped on at between 8 and noon. Right, price can only do two things. It can either reverse or retrace. So since we've been consolidating, right, price at the turtle soup and then crash at 8:30 news. So that was the other alignment that happened. And then going back to the objectives again, our intermediate term perspective was bearish, and our 4-hour H4 POIs was as highlighted. So we going into the week, we highlighted this order block here being 50% of that is being this. We have on NASDAQ, I think there's a breaker here. And then we have this huge fair value gap. If you map it out, right, this is still within that 70 percentile or 79 percentile, right? Anything between 65 to 79 percentile is our OTE. Align that with the higher time frame and intermediate term perspective. So this movement up was doing a turtle soup into this area and then flushing. So it did not, or did not, I guess 1 hour or two. So this would be the area of nonetheless importance there. So our H4 POI, we identified it in news. We had a CPI coming out on Wednesday of this week at 8:30 news. That's what the CPI drop was, right? Wednesday CPI news, and then Thursday was PPI. So going into the week, we were expecting at least a bearish push, right? Remember, because based on the fact that this week closed bearish, we were expecting a bearish push here, at least to these lows. And if we came down to those lows, we would be tagging this internal range liquidity here. So going into the week, we were bearish, and if you line up the news, we could have had two profiles folded. We could have had a classic expansion week. Monday, Tuesday created a high, right? That would have been probable because going into Monday, Tuesday, we were very close to these POI on 4-hour chart. We were actually in this POI, right, by Tuesday and Monday, because Friday created started this moving up, right? Monday we kind of consolidated. We don't trade anyways on Mondays. Tuesday you could have elected to see that as being the high of the week, so potentially high of the week classic expansion. But this movement here was not very convincing by 10 o'clock, right? We kind of went back into that range again. So this V-shaped movement was not very convincing that Tuesday is going to be the high of the classic week, right? Classic expansion week. So we move on to Wednesday. Wednesday has a news driver, right? Has a news driver, high impact news. So possibly Wednesday could be the high of the week, which would be the weekly profile as being midweek expansion. I like to call it midweek expansion. Expansion to the bearish side, so bearish midweek expansion. So we confirmed that on Wednesday. We had a significant break below this low. We started tagging below this low here. So this Thursday movement, in an ideal world, you want to see Thursday kind of consolidate or even push lower, and then Friday push lower again. That would be your midweek classic midweek reversal. Alternatively, Thursday can do this type of movement where it moves up and then moves down. So if that movement is up, usually on Thursday, that's a market maker buy to a market maker sell model, usually, right? So going into that week, we expected some type of bearish movement below this low. We hit those low, not very convincingly. We nonetheless hit those lows, and then we kind of went back into that range. So ideally, I would have wanted to see a 4-hour shift in market structure, right, like we did here. But Thursday we did not do that. So because we did not see a shift in market structure just like this, Thursday started pushing up, and then Friday went lower. I know I'm beating this topic very much into it. There's more than one way to look at the same thing, and I want to be able to look at it, at least talk about it in multiple ways, so that when the live candle starts printing, I can automatically see these things very clearly in my head. So we identify the weekly profile or potential weekly profile, and then the next day model, right? So if you go back to that, so next day model is based on the fact that it's a 1-hour chart, right? So again, if you look at previous week, we did not close below this week, right, on Wednesday, and then Thursday we started hanging around up until this movement up here. We PPI number, right? Thursday was the PPI number. It closed higher, and then another tagging in here to move up. So Thursday, you could have seen this as a change in state of delivery. Again, the reason Thursday would not be a good day to trade, because you're seeing bullish activity, right? Once you start seeing bullish activity, when you know that higher time frame bias, higher time frame perspective, and intermediate term perspective are bearish, when you started seeing a bullish movement here, all of a sudden, you know this is a manipulation here, or it could be a manipulation, especially when it gets to this 1 hour order block here, right? Now, 1 hour order block, you would expect some type of a SMT here. You have a further SMT because on NASDAQ, if you look at NASDAQ, right, you created this high here. So from this high to high, right, whereas ES, it created that low here. And on top of that, if you zoom into 15-minute chart, you'll see that on NASDAQ, this high was higher. So you have a high, lower high, versus in NASDAQ, you have a high, higher high in an area where it's supposed to be bearish, right? So you know that you have a confirmation that this would be a manipulation here from here to here. So market maker buy into a market maker sell model again, right? Those are the identifying factors there. So identifying factor actually came through PM session, right, on Thursday, April 11th. So it came back in a PM session, and then Asia kind of consolidated. I thought about putting a position here for a put option, but when I looked at the clock, it was like 4:09 or something like that. Or yes, it was like I started looking at here. I think 16:09. So 4:09. I started looking at it here. I started to enter here, but then I realized the market was closed. So you have a first cue that this was going to be a bearish. Now, I'm guessing that's when this. I'll talk about the option later, but this is where the next day model would come in, and the trade setups that I took basically came off of a next day model on Friday, and then on a Wednesday, right before the PPI release. It was a gamble play almost, but with a tighter stop loss. I had a tighter stop loss, or 1 to 2, or 1 to 3 was, I think, ended up being what that trade setup looked like. But that was a little bit of gambling. Retrospect, CPI can be tradable from what I've been reading on the or hearing on the different types of videos, and although it's not recommended, obviously I'm not saying to trade that news, but CPI has very what do you call it, it's very predictable. CPI is very predictable how it's going to react, and it's most of the time I've been noticing CPI reacts just like this. You have a sharp up movement followed by a huge down movement, so that could be a very classic CPI. Now let's talk about what I learned this week. So what I learned this was the fact that this movement here, right? So you have this movement here with Thursday, right? Thursday it created a lower high here, versus Nasdaq, it has created a higher high, right? This Thursday created a higher high. So in that intermediate term perspective, right? In that intermediate term perspective, you have a external range liquidity taken. If external range liquidity is taken, right, where should the price come down to? Well, price should come down into this internal range liquidity, right? There's the internal range liquidity right there. So if this internal range liquidity is being violated, right, because the CE of this internal range liquidity was violated, we tapped this fair value gap here, we closed in that fair value gap, right? Then what do? Right? Then we start on 15 minutes. Let's go to 4 hours. Go to 15 minutes, right? We started breaking through that area on today. So we started breaking through these fair value gaps earlier, later in London, and early in New York session, right? We started breaking through that. We break through this CE of the fair value gap, and this is where I started entering here. I think that was my trade down to here somewhere. So what I wanted to talk about was the fact that an NQ, the 4 hour, we had a intermediate term perspective. We have external range liquidity taken. We have an internal range liquidity getting seeked, right? Now compare that with the ES. So in ES, this movement up, we did not take external range liquidity, right? Instead, we went into this internal range liquidity. After taking out this external range liquidity, which we did in an NQ, right? NQ, we never took out the external range liquidity. We took out this external range liquidity. So either way, we're both going. So there's two ways to look at it. We both took out external range liquidity on different days. So that's a different topic. So if you look at ES, we came into this internal range liquidity, same thing happened. What happened with NQ, it started breaking through that fair value gap, right? On NQ, it started breaking through that fair value gap on 15-minute chart. The following day, right? This is the movement down. The following day, we started breaking through that. And ES, what I want to show here is the fact that we come into this internal range liquidity, which is highlighted by, let's just say, was highlighted by this. Okay, just keep everything the same. And if you look at the CE, or you can measure this, right? You have a lot of things around the CE area here. Right? We reached that on Thursday, right? So that was what's confusing me. Okay, now we're good. So CE right here, right? We go up to that CE, which is right here. You just have to look at the CE, nothing else. I need the CE to be more vibrant. Midline here. If you look at the CE of that, right? We go above it, and then we break below it. London, we break, right? In that CE. So the same CE, right? So you have internal range liquidity here coming up to that internal range liquidity, and then we started breaking. Now, once we come up to this internal range liquidity, after taking the external range liquidity, where would the prices go? To an external range liquidity. Where's the external range liquidity if you started breaking from here, below here, right? Because we came to an internal range liquidity, our next level is going to be external range liquidity. That's why these lows were taken. Now compare that with NASDAQ, right? We went from an external range liquidity to internal range liquidity. We broke through it, right? But at the low-hanging fruit is this internal range liquidity in this 50% area, right? In this 50% area. So below here would be where you'd be looking to exit, right? Because it might not make it to this external range liquidity on the same day, because its only objective is to go to an internal range liquidity, which is in this 50% area, right? That's why this would be your first take profit. So that came about pretty early, 15-minute chart. So 50% here, so yeah, that came pretty early. So you could have elected to enter here. This is the here. So this is where I entered on N, right? So the idea is that you'll be only taking profit up to here. Now you can leave one for the external range liquidity, but the chances are lower because it's coming from an internal range liquidity. That's what I wanted to say down here, is that that's why these lows were taken out on ES and not NQ. And these lows were taken out easily with like a knife through butter and into this internal range weekly. So in short, there's two things I learned. The first is that the correlating assets, right, ES and NQ, although they're both in a downtrend, and our high time frame and intermediate term time perspective has confirmed that we are at different intermediate term liquidity, right? And within that longer term, our intermediate term is still going to be external to internal, right? And correlating assets could be at different levels. So this is coming into internal, whereas NQ coming into external, right? NQ coming into external. So our correlating assets are showing divergence. That's another way of saying it. And the second is that is expected. The second thing I learned is that this is expected, right? If you look at correlating assets or inverse assets like dollar and or correlating assets like the pound and the GBP, right? Pound and euro and pound. Basically, if you look at the correlating assets, within those correlating assets, one is stronger and one is weaker. So this clearly is telling me that it's absolutely, you're looking for this. This shouldn't be a shock, right? It shouldn't be a shock that they're at different price levels here and above or below different price levels. So this should not come as a shock that you are expecting this. And correlating assets with Forex is going to be those the two pair, Euro USD and GBP, right? And then you have to compare that with the dollar. Right? The dollar is going to be a different perspective as well. The dollar might be making um, external range liquidities, whereas the correlating or uncorrelating assets are not taking those external range liquidities, right? So dollar by chance, right? It's going to be more of a stronger pair, right? It's not going to go down as deep, right? It's going to go higher, but it's not going to go down as deep. Whereas the weaker pair, in this case the ES, it's going to go up, not go up as high, but go down more deeper, right? So those are going to be the different things to look at and to be expected. And I think that's what I learned.